Have you ever wondered how founders of companies can lose billions yet still emerge wealthier than ever? In the world of business, it seems counterintuitive that a company can report staggering losses while its founders bask in the glow of immense wealth. Take Meituan, for example, which lost a whopping 115 billion yuan, yet its founder Wang Xing's net worth soared to 170 billion yuan. How is this possible? The secret lies not in the profits of the companies, but in the equity premium that investors enjoy, often overshadowing the actual financial performance of the companies themselves. What if I told you that the real winners in these scenarios are often the investors rather than the companies themselves? When a startup begins its journey, it often relies on angel investors who provide initial funding in exchange for equity. For instance, if an investor puts in 1 million yuan for a 10% stake in a company valued at 10 million yuan, they are not just betting on immediate profits. They are banking on future growth and valuation increases. As the company raises more funds and its valuation skyrockets, sometimes to hundreds of millions, those initial investments can multiply exponentially. This is where the magic happens. Even if the company is losing money, the investor's stake can appreciate significantly. The US presidential election has come and gone, but its reverberations continue to echo through the financial markets. Even 6 weeks on, traders are grappling with the implications of a new administration and its potential impact on the economic landscape. The transition of power always brings with it a degree of uncertainty, and this time is no different. As we navigate this evolving terrain, it's crucial to understand the key factors at play and their potential consequences. Welcome to our channel where we unravel the mysteries of modern finance and entrepreneurship. Today, we delve into a fascinating paradox that has left many scratching their heads. How can companies lose billions yet their founders thrive in wealth? Join us as we explore the intricate dance of equity valuation, strategic losses, and the art of storytelling that turns financial despair into entrepreneurial triumph. If you're curious about the secrets behind the billion-dollar business game, this video is for you. Don't forget to like, subscribe, and hit the notification bell for more insights into the world of business. If you found this exploration into the paradox of billionaire founders intriguing, don't forget to subscribe for more thought-provoking content. Share your thoughts in the comments below. How do you perceive the relationship between losses and entrepreneurial success? Join our community as we continue to uncover the secrets behind thriving in today's complex business landscape. Navigating the financial markets in the wake of a US presidential election demands a keen understanding of the forces at play. It's not just about who occupies the Oval Office, but also about the broader economic and geopolitical context. The decisions made in Washington, D.C. have far-reaching consequences influencing global trade, currency valuations, and investor sentiment. The coming week is poised to be a pivotal one for financial markets, as a wave of economic data washes ashore, offering crucial insights into the health of the US economy and potentially shaping the Federal Reserve's monetary policy course. Traders and investors alike will be keenly watching these releases, looking for clues about the strength of the recovery, the trajectory of inflation, and the Fed's likely response. The US economy stands at an inflation crossroads, a pivotal moment that could shape the financial landscape for years to come. Recent data paints a mixed picture, with some indicators showing resilience while others signal potential trouble ahead. This has left both policymakers and market participants in a state of heightened alert, constantly monitoring the situation for any signs of change. On the one hand, supply chain disruptions, surging energy prices, and robust consumer demand have all contributed to a surge in inflation, pushing it to multi-decade highs. Consumers are feeling the pinch at the pump and in stores as prices for everyday goods continue to climb. This has led to inflation reaching levels not seen in decades, causing concern among economists and the general public alike. On the other hand, there are signs that some of these inflationary pressures may be starting to ease, with commodity prices showing signs of stabilization. This offers a glimmer of hope that inflation might be peaking, providing some relief to those worried about the future. The Federal Reserve, tasked with maintaining price stability, faces a delicate balancing act in this complex economic environment. Moving too aggressively to combat inflation risks derailing the economic recovery, potentially leading to higher unemployment and slower growth. Conversely, remaining too accommodative could allow inflation to become entrenched, eroding consumer purchasing power and making it harder for families to make ends meet. This delicate situation requires careful consideration and precise action to avoid long-term economic damage. The goal is to ensure that inflation does not undermine long-term economic growth, while also supporting a robust and sustainable recovery. The Federal Reserve is currently engaged in a high-stakes balancing act, attempting to navigate the treacherous terrain between taming inflation and sustaining economic growth. This delicate maneuver requires precision and foresight, as the consequences of missteps could be far-reaching and severe. The task is further complicated by the lingering uncertainties surrounding the pandemic, geopolitical tensions, and the evolving economic landscape. These factors create a volatile environment where traditional economic models may not apply, making the Fed's job even more challenging. On one side of the scale lies the threat of inflation, which has surged to its highest level in decades, fueled by supply chain bottlenecks, strong consumer demand, and rising energy prices. This inflationary pressure is not just a domestic issue, but a global phenomenon, affecting economies worldwide. Uncontrolled inflation poses a significant risk to the economy, eroding consumer purchasing power, undermining business investment, and potentially destabilizing financial markets. If left unchecked, it could lead to a vicious cycle of rising prices and wages, further exacerbating the problem. On the other side of the scale lies the need to support the economic recovery, which, while showing signs of resilience, remains fragile. The recovery is uneven, with some sectors bouncing back quickly while others lag behind, struggling to regain their footing. Prematurely tightening monetary policy could stifle growth, potentially leading to job losses and a decline in economic activity. The Fed must carefully weigh its decisions, considering both the short-term impacts and the long-term health of the economy. Balancing these competing priorities is no easy feat, requiring a nuanced approach and constant vigilance. The US dollar, a bellwether of global financial sentiment, finds itself at a crossroads in the wake of the US presidential election. The greenback's trajectory remains uncertain as market participants grapple with the potential implications of the new administration's policies and the evolving economic landscape. Is it possible that profitability is just an illusion crafted by savvy financial maneuvering? Consider this. Companies like JD.com have reported losses for over a decade, totaling more than 30 billion yuan. Yet, founder Liu Changdong remains a billionaire with a net worth of around 900 million yuan. How does this work? The answer lies in financial engineering and market perception. By optimizing financial statements and attracting new rounds of investment, these companies can create an illusion of potential that keeps investors interested and valuations high, even when actual profits are nowhere to be found. What lessons can we draw from Sun Tzu's Art of War regarding these business strategies? In warfare, as in business, strategy often trumps brute force. Founders and investors alike must navigate a battlefield filled with uncertainty and competition. The key is to focus on long-term vision and strategic positioning rather than short-term gains. By understanding market dynamics and leveraging investor psychology, founders can maintain their wealth even amidst losses. This strategic foresight allows them to weather storms while their net worth continues to climb. Inflation has emerged as a dominant theme in financial markets, capturing the attention of investors and analysts alike. Recent data shows consumer prices rising at their fastest pace in decades, a trend that has not been seen for a long time. This surge in inflation has raised significant concerns about the potential for the economy to overheat, leading to unsustainable growth. Consequently, there is mounting pressure on the Federal Reserve to adjust its monetary policy course to address these inflationary pressures. The Fed, tasked with maintaining price stability and fostering economic growth, faces a delicate balancing act in these challenging times. On one hand, the central bank wants to ensure that the economic recovery remains on track, supporting businesses and consumers alike. Additionally, the Fed aims to see continued improvement in the labor market with more job opportunities and lower unemployment rates. On the other hand, the Fed must also take decisive action to prevent inflation from becoming entrenched and spiraling out of control, which could destabilize the economy. If inflation were to spiral out of control, it could lead to an economic crisis marked by out-of-control prices and financial market volatility. The upcoming release of the core PCE price index, a critical economic indicator, which is the Fed's preferred measure of inflation, will be closely watched. Market participants will scrutinize this data for clues about the trajectory of price pressures and the Fed's potential response, making it a pivotal moment for financial markets. How does the concept of burning money contribute to market expansion? Are losses bad then? Or are they strategic? Losses in this game are investments in a bigger story. Let's take a leaf out of Sun Tzu's playbook. Appear weak when you are strong. These companies burn money to conquer markets, subsidizing customers, slashing prices, and expanding like wildfire. The goal isn't to make a profit now, but to crush the competition, secure market dominance, and then dictate terms. Consider SoftBank's Masayoshi Son, who invested $20 million in Alibaba. The company initially struggled, but by the time Alibaba went public, that $20 million had turned into $60 billion. Did losses along the way matter? Not at all. The losses were merely the fertilizer for the money tree. The release of the minutes from the Federal Open Market Committee's last meeting is always a highly anticipated event for market participants, as it provides valuable insights into the Fed's thinking on the economy, inflation, and the path of monetary policy. This time around, the minutes will be scrutinized even more closely than usual, as investors seek to gauge the Fed's level of concern about inflation and its potential response. So what's the secret sauce? The poor traditional businessman, diligently running a mom-and-pop shop, measuring profit margins and balancing the books. While they toil away for modest returns, venture-backed startups live in a parallel universe where losses are sexy and valuation is king. Why does this strategy make traditional business owners feel left out? Here's the trick. Traditional businesses focus on profits, but venture capital sees losses as a growth strategy. It's like comparing a tortoise to a rocket ship. Sure, the tortoise is stable, but the rocket ship, even if it explodes a few times, aims for the stars. Or as the Yi-Jing might put it, the inferior man profits today, the superior man invests in the infinite. What mindset shifts are necessary for entrepreneurs in today's market? The incoming administration faces a delicate balancing act as it seeks to implement its economic agenda while navigating the challenges of rising inflation and an uneven economic recovery. The president-elect's campaign promises of increased fiscal spending on infrastructure, social programs, and clean energy have the potential to boost economic growth, but they also raise concerns about potential inflationary pressures. Amidst the uncertainty surrounding the U.S. economic outlook, the Atlanta Federal Reserve's GDP-NOU model offers a glimmer of optimism, projecting a stronger-than-expected growth rate for the fourth quarter of 2023. This projection, while subject to revision as more data becomes available, suggests that the U.S. economy may be more resilient than some had feared. The GDP-NOU model, which uses real-time economic data to estimate GDP growth, currently forecasts a 2.6% annualized growth rate for the fourth quarter. This figure, if realized, would represent a significant acceleration from the third quarter's estimated growth rate and would signal continued economic expansion. The US dollar's fate hangs in the balance as market participants weigh the potential impact of the incoming administration's policies, the Federal Reserve's monetary policy path, and the overall health of the US economy. The greenback's performance in the coming weeks and months will likely be driven by a complex interplay of these factors. On the one hand, the prospect of increased fiscal spending and the potential for a more dovish Treasury Secretary could weigh on the dollar. The euro finds itself navigating a turbulent sea, buffeted by the strengthening US dollar and overshadowed by the ongoing conflict in Ukraine. The shared currency has been on a downward trajectory against the greenback, with some analysts speculating about the possibility of the euro reaching parity with the dollar for the first time in 2 decades. Can the ECB break the cycle? European Central Bank President Christine Lagarde faces a formidable challenge as she attempts to steer the Eurozone economy through a period of soaring inflation and heightened uncertainty. Inflation in the Eurozone has reached multi-decade highs, driven by supply chain bottlenecks, surging energy prices, and robust consumer demand. Lagarde has vowed to bring inflation under control, but the path forward is fraught with risks. Why is market dominance prioritized over financial stability? The modern startup world flips traditional business wisdom on its head. Instead of focusing on immediate profits, today's most successful entrepreneurs strategically prioritize market domination, equity valuation, and future potential over financial stability. The upcoming release of the harmonized index of consumer prices for the Eurozone will be a key test for the European Central Bank and its efforts to combat inflation. The HICP is the ECB's preferred measure of inflation, and a hotter-than-expected reading could fuel speculation that the central bank may need to tighten monetary policy more aggressively than previously signaled. Economists and investors alike will be closely scrutinizing the HICP data for signs that inflation is becoming more entrenched, or conversely, that it may be starting to ease. What is the importance of storytelling in attracting funding? A compelling growth story attracts successive funding rounds. Investors are drawn to the prospect of higher returns, even if profitability remains elusive. As valuations rise, early investors and founders reap substantial rewards. The European Central Bank finds itself walking a monetary tightrope, attempting to balance the need to tame inflation with the imperative of supporting a fragile economic recovery. The central bank's task is further complicated by the ongoing war in Ukraine, which has injected a significant degree of uncertainty into the economic outlook. To successfully navigate the future economy, it is essential to adopt careful, intelligent strategies that emphasize balance and adaptability. The post-election financial landscape presents both opportunities and challenges for traders, with volatility serving as both a double-edged sword and a constant companion. The key to success lies in understanding the forces driving market swings and adopting strategies that mitigate risks while capitalizing on emerging opportunities. From embracing change to finding the right balance between empathy and determination, these principles provide a refreshing perspective on business management. In the intricate world of finance, where fortunes are made and lost with the blink of an eye, mastering the art of trading requires a multifaceted approach that combines technical prowess, fundamental analysis, and an astute understanding of market psychology. This is especially true in the aftermath of a US presidential election, where the ripple effects of policy changes and economic uncertainty can create a complex and constantly shifting landscape. The importance of balance and strategic thinking cannot be overstated. The key is to find the ideal equilibrium and maintain agility, much like a tightrope walker with a safety net. In the fast-paced world of financial markets, information is king. Those who possess timely, accurate, and insightful information have a distinct advantage in making informed trading decisions and capitalizing on emerging opportunities. This is particularly true in the wake of a US presidential election where policy changes, economic data releases, and geopolitical events can rapidly shift market sentiment and create volatility. The current global market situation is complex, and it is a mixture of favorable and unfavorable conditions, presenting both opportunities and risks. As we conclude our analysis of the US presidential election's ripple effects on the financial markets, it's clear that we're sailing into uncharted waters. The confluence of a new administration, evolving economic policies, and persistent global challenges creates a complex and dynamic landscape for traders to navigate. The path ahead is unlikely to be a straight line. The environmental resources of each region on Earth are distinct due to their unique latitudes and longitudes. In the ever-shifting sands of the financial markets, where change is the only constant, adaptability emerges as the cornerstone of success. Traders who cling rigidly to outdated strategies or fail to adapt to new information risk being left behind as the market marches on. We can summarize real-time opinions by using advanced artificial intelligence technologies such as neural networks, which take into account regional characteristics and national economic data. Remember, knowledge is not only a tool to enhance your value, it is also a form of power. As we conclude our exploration of the US presidential election's impact on the financial markets, it's important to remember that knowledge is power. The more you understand about the forces driving market movements, the better equipped you'll be to make informed trading decisions and achieve your financial goals. As we conclude this episode, I would like to extend my sincere gratitude to all of our viewers for their continued support. If you found today's video helpful, please like it so that you can easily return to it when needed. Thank you for your attention and support.
Thank you.